Let's take a look at what happened yesterday. In this chart, you'll see there were some significant sell offs, and that created a situation where mortgage rates did rise. So, yesterday, the national average was 6.33 in the morning, and by the end of the day, we were at 6.5. Now, today's market story is fairly straightforward. Oil prices did improve slightly, and the bond market improved a little bit as well. However, that national average is still standing firm at 6.5, at least for now. Lately, that connection has been one of the clearest drivers of interest rates. When oil falls, inflation fears ease a bit, and mortgage rates typically improve. There was a really large batch of economic data, so let's take a deeper dive into that. Jobless claims and inflation readings, but markets mostly ignored it. And that's been the most common theme lately as well, where the economic data is taking a backseat to the geopolitical environment and those headlines. The only small surprise came after the data. Jobless claims were stronger than expected, normally a negative for rates, yet bonds still slightly improved. Inflation, or PCE, rose to 3.5% year over year, but markets seemed relieved it wasn't higher. And that combination helped rates move in a slightly favorable direction. Why this matters for mortgage rates. Mortgage rates are following bond yields, and bond yields are still closely tracking oil prices. So, today's takeaway, we've got lower oil, a little bit less inflation pressure. Less inflation pressure equals better bond performance. Better bond performance is a potential for improvement in mortgage rates. So, even with strong economic data that could have pushed rates higher, falling oil prices help to mitigate that effect. So we'll have to watch and see what happens with oil prices and how it continues to affect our mortgage rates. I hope this information helps. If it does, give me a like and a follow, and I hope you have a great day.